All right. Hello, everybody. Just a heads up that we are recording this. So in case you have to step away for a second, we'll send you the recording afterwards. I first wanted to start off and thank all of you for being on the call today. And most importantly, for your continued trust and support during these difficult last couple months. Our team's been working really hard to provide a lot of information, make sure that you had everything you need over this time. And hopefully that has been helpful during this process. Before I introduce our guest speaker, I first want to review some of the resources that we have available through our high net worth program with LPL. We focus this on 5 main areas that we get the most questions about. The first one is financial planning. Second is charitable giving. Third is estate planning. Fourth would be insurance needs. And then lastly, tax planning. So first, for financial planning, we've implemented Wealth Vision, which I use on a daily basis for my clients. Wealth Vision allows us to run advanced planning scenarios, upload documents to a secure vault, and also run many different projections for our clients that they might need. The next area that we touched on was charitable giving. Charitable giving is an area that we continue to get more and more questions about as we grow our business. For charitable giving, we're able to set up donor-advised funds, give advice on endowments and foundations, and also use more long-term giving strategies. The third area that we receive a lot of questions on are trust, wills, and estate planning. We have made a lot of relationships and connections with local estate planning attorneys, but we also have a partnership with a private trust company through LPL Financial. The private trust company is able to act as a corporate trustee for our clients, give us some feedback on estate planning documents, and really just help us with more complicated estate planning scenarios. The fourth area that we've improved recently is we have a dedicated insurance specialist now. Our dedicated insurance specialist is able to help with life insurance, disability insurance, and also help with health insurance and long-term care planning needs. Those are all really important parts of a comprehensive financial plan. The last area, and the biggest improvement that we've made recently, is we're in the process of adding an in-house CPA or accountant. This will be a huge help for all of our clients because we often get requests for referrals to outside CPAs. Having one in-house will allow us to work more closely with our clients and make sure the plan is working cohesively together as we work through the financial planning process. We're hopeful to have that ready to go by the end of the year. And lastly, we also have access to LPL Financial's private client group to work on more complicated cases. They're a great resource to have, and they give us access to a lot of other tools and strategies that we wouldn't normally have access to. One of those, which is why we're doing this today, is we have access to LPL Financial's senior market strategist, Ryan Detrick. Ryan and his team have been very valuable over the last couple months by providing additional insights into the economy and the market. And most of those times, they tend to agree with our thoughts, which is always helpful for us. Ryan, if you didn't see his bio on the invitation, frequently appears on business TV, whether it's CNBC, Fox Business, and Bloomberg. And with that, I'm going to let Ryan take over.
All righty. Thank you, Matt. Appreciate that intro. So yeah, I've been with LPL for, let's see here, I guess 4.5 years now. So I've seen a lot, and I'll tell you guys, I've been doing this over 22 years, originally from Cincinnati, Ohio. Moved with my wife and kids down here to the Charlotte area. I am in South Carolina, just across the border from Charlotte. Charlotte's on the border. But for the 22 years or so I've done this, I mean, this is what we've seen so far this year. And isn't it crazy to think the year is, not even half over? I mean, oh my goodness. What a wild ride 2020's been. But we've got a lot to discuss here. I know we've got some Q&A as well at the end. So maybe if we could, let's pull up the slides, please. Let's get those up here. And, we've got this presentation I'm going to discuss. Sure. Should I be able to see them? Let's see. There we go. There we go. Perfect. There it is. Awesome. Yeah, I've never used this interface before. This is really neat, though. So this is working good. So how bad will it get? I mean, this is a COVID-19 update, market update, Fed update, economy update. There's a lot of stuff we're going to talk about here. The reality, though, is this. This was the worst recession that we've seen since the Great Depression. And how did it start, right? I mean, let's start real simplistic. What caused it? Well, it was the government. The government told us to stay inside. We shut down half the country, 75% of small businesses. We're not disagreeing with that, okay? I mean, we think it was absolutely necessary to do that to stop the initial spread of COVID-19. Now, I'm fully aware that we continue to see more and more cases, but at the same time, we are much more prepared to fight this than we were just 4 months ago. And I'll get into all of those things. But you think about how you stop your car. Slam on the brakes, pump the brakes, hit a tree. The reality of the fact is our economy hit a tree. And we've never quite seen something quite like this. Fastest bear market history, fastest 30% correction in history. Into March 23rd, obviously, we were all very, very worried with our stocks going down. Even your bonds and gold were going down the middle part of March. It was really petrifying. And now, sure enough, we look, and as of today, the S&P was up 74 basis points, made a new all-time high. I'm sorry, the NASDAQ. NASDAQ up 74 basis points. And NASDAQ is up 8 days in a row, literally making all-time highs as we speak. I don't think even the wildest bull in their imagination, 4 months ago when things were really, really scary, or 3 months ago when things were really scary, would have ever imagined even that taking place. But it's happening. So let's go to the next chart, which I think is just some lawyer stuff to keep the lawyers happy. Yeah, so let's leave it there just for a second. Again, you think about how this happened. We're on record at LPL Research saying this would likely be one of the shortest recessions ever. Because coming into this recession, we didn't have a lot of the same problems you have. At the end of economic cycles of growth, you have what we call the overs, the excesses, overspending, over leverage, overconfidence. Honestly, guys, the consumer was in pretty good shape heading into this. Small businesses were in pretty good shape heading into this. Now, when you shut the economy down for a couple of months like we have, clearly that's going to impact things. But it's such a different environment coming into this recession than any other that we've ever seen before. And as, again, we get to the other side, and honestly, we're again on record saying this recession, it might not be over quite yet, but very likely over the next month or so, it could be. We've had some unbelievable economic data. I mean, the recent jobs number, it came in only 10 million more jobs created than what the economists thought. The retail sales number we had a week ago came in at 18% up month over month, way above any of the estimates the economists had. I mean, there's an old joke about economists, why God created the economists. To make weather forecasters look good. You think about what's happening right now. The good news is the economy is really beating things to the upside. And it's almost justifying, if you will, some of the major move that we've seen in stocks. I mean, the reality is stocks lead the economy. You think about February, March, stock market selling off. Economic data wasn't that bad. We hadn't had the scary headlines yet. But then the stock market started going up in April and May when the headlines got scary. Now here we are right now with some really good economic data. We would not be surprised at all if after a 45% rally in stocks here, we kind of had a consolidation. Think about this. In 2003, March 2003, major market low. Market made a low, went up for a couple months significantly, consolidated the rest of the summer, and then broke higher the second half of that year. 2009, major stock market low in March. Went straight up for a couple months, consolidated the summer months, eventually broke out to new highs. Here we are. What did Mark Twain tell us? History doesn't repeat, but it rhymes. Well, we bottomed in March, historic rally, and sure enough, we think some type of consolidation these summer months makes a lot of sense, and eventually higher prices I'm going to lay out here are what LPL Research sees. But let's go to the next chart. Let's show a little bit about me. So I get to go on TV, get to talk to clients and travel the country when things are more normal. An interesting fact about me is if you ever pause the TV, I look just ridiculous no matter when you do it. Here I am. My kids just get a real kick out of this. I think I'm like playing a, what do you call it, turntable, I guess, in this particular one. Show the next slide, and let's see what I'm doing in the next one. Apparently, I turned orange. I have no idea why. I guess my tie's too tight or my shirt's too tight, but I officially turned orange on CNBC. I make a joke. I turn orange when I'm lying, so I don't know what I was talking about this day, but teasing there. Let's go to the compliance. Wouldn't like that. I'm kidding. Let's go to the next chart. I don't know. I do all these crazy things with my hands. I don't even know. I don't know. I can't explain it. I just do it. Look at the next one, though. This is like Angry Ryan here. I don't know. It must have been on March 23rd. Stocks must have been down a lot. I must have been mad at the world. I don't know what in the world I'm doing there. Let's go to the last one. And here you go. Here you go. Here's the thing about us TV, right? They tell you you're going to be coming on soon. You really don't know when. I'm in this big black room. We've got a big, so we're at the campus here in Charlotte. You ever make it to Charlotte, hit me up. I'd love to show you around our campus. We've got a studio that I get to do the TV hits in, and you're just staring off in this black space. You can't see anything. I'm just drinking some water. Like, oh, Ryan Detrick. I didn't even know I was on TV. And there I am, live on CNBC. That was like a month ago, I think, taking a drink of water. And I was supposed to be on CNBC tomorrow, but I just found out they canceled it for some reason. So it happens. But anyway, so that's a little fun stuff about me. So let's go to the next slide here and get kind of into some real things here. So how you guys feel, right? I mean, history tells us fear and greed tend to be all over the place in the stock markets and relationships, just the way we look at the world. And you think about it, when things are most fearful, as you see on the slide there, that's when people are selling. And when people are greedy, that's when we're buying. And then it just continues to repeat until broken. I don't think it's ever going to break necessarily, in my opinion. Now, here's something that's really unique. Ivan Pavlov, he's a famous psychologist in Russia. He did a study that he found dogs. He fed his dogs, but before he fed his dogs, he rang a bell. Well, it took the dogs about a week to realize that bell meant you're about to eat. And you know what the dogs started to do? As soon as they heard a bell, they start to slobber a little bit. But what happened, there was a horrible flood in 1924 in Russia. And sadly, a lot of the dogs died, but some of them had to swim a half mile to land. And after that terrible, tragic event took place in their lives, Pavlov rang the bell. They didn't slobber. This wasn't just one dog. It was like all the dogs didn't slobber anymore. When you have a traumatic, horrible experience, it does something to our brains, and it changes how we see things and how our perception of things, and almost makes us forget things. And when you have that fear, when you have that at the bottom, like on March 23rd, when the S&P is down 34%, that is when you're going to forget what you should have known. You're going to make the worst investment decisions you can, because when you call up Matt and the team and you say, hey, what's going on? Why are stocks down? Why are my bonds down? Why is gold down? That's why it's so important to have a plan in place. And I think it's almost cliche. You have to use this quote every presentation, the Mike Tyson quote, right? You have to have a plan, because everybody's got a plan until you're punched in the face. And that's why it's so important to work with Matt and the team to have a plan in place. Because here's the truth. I'm not allowed to give predictions. Well, predictions, I guess. Guarantees is the word I'm looking for. So with about as much certainty as I'm allowed to say, sometime over the next 30 to 40 years, we're probably going to have another 20% correction in stocks, maybe even another 30% correction. It's going to happen. It's going to feel like the end of the world. It's very, very devastating when it happens, and the horrible headlines, and 100,000 people have died in the U.S. and almost 500,000 people around the world. I mean, it's terrible what's happening out there. But again, having a plan in place from your investments point of view is so, so very important, because again, fear and greed are what drive humans' emotions, and that continues to drive the stock market. Let's go to the next slide. So how do you feel? Here are some recent magazine covers. I mean, these are just devastating magazine covers. Now, again, getting on the psychology side of things, red and black are colors that when you see it, you have a certain reaction of kind of fear, okay? And magazine covers know that. So they use red and black when things are scary. Those magazine covers all took place, last couple of months. That New York Times on the right, that's a newspaper, obviously. That big red line, which is on the right, all the way down the front page, that's 20 million jobs lost. You can see how large the job loss was that we just had back in April. I mean, just unbelievable. The previous record job losses, I just combined the word job and losses there, job losses was about 2 million in World War II, 10 times worse. I mean, just unbelievable. You think about how quickly the economy is going to come back, and I'm going to talk about the economy, but here's the truth, right? It's going to take a while to get those jobs back. If you look at the financial crisis, Great Recession, it took 7.5 years for jobs to fully come back to where they were before the recession started. Look at the tech bubble, the previous recession before that. 4 years for all the jobs to come back. The truth of the matter is there are parts of this economy that absolutely are coming back quicker, but there are parts that are going to take a long, long time to recover. And the sad truth is it's probably going to take years for jobs to officially all the way come back to where they were. But again, a lot of scariness. So let's go to the next slide. And, here's I think the most 2020 thing I've ever heard. I feel tired. This is kind of the way I describe 2020. Coronavirus. Monkeys escape with COVID-19 samples after attacking lab assistant. One of the primates was reportedly later spotted up in a tree chewing on one of the sample collection kits. That is the most 2020 thing I've ever seen. It took place in India. Let's go to the next slide. Let's get serious now, because there are some things we want to talk about here that are really impacting all of you. What we just had, first off, pat yourselves on the back. We made it through the most volatile month in the history of the stock market. The Dow Jones started, let's see, it's May 26th, it's May 24th. May 24th, 1896. Bottom line, 124 years ago. The month of March was the most volatile month we've ever seen in 124 years. The average daily change, either up or down, was 5% a day. 5% a day is what we saw the month of March. The previous most volatile month ever was in November of 1929. Average day is like 3.8%. So all you got to know is what we've seen this year is in all likelihood something we're not going to see in our lifetime again, but it happened. And it has been an unbelievable ride. But what the screen shows you is how quickly that bear market took place. 19 trading days. Now take note, 21 or 22 trading days is about a month. So less than a month to go into a bear market. That's from an all-time high to a bear market. Faster than 87, faster than 29, faster than some of the other spectacular bear markets that we have seen. Also, it was fastest bear market for the S&P 500, fastest 30% correction ever. I mean, it was just devastating when you stop the global economy. Not shocking. You stop the global economy when things are humming. Think about in February. February 19th, the S&P is making a new high. The economy's turning around. We had a slowdown the fourth quarter last year. Things looked really, really good. And sure enough, 2 weeks later, everything had changed. Let's go to the next slide. So the expansion is over. We just had a 10.5-year expansion in stocks, in the economy. And it came to a screeching halt. The NBER, that's National Bureau of Economic Research, they're the guys that say, yep, we're in a recession, or yep, we're in an expansion. They came out and said we're officially in a recession, surprising no one. The economy peaked in February, recession started in March. Now, what you see on the screen here, this expansion was over 10 years. Look at GDP. That's your economy, right? It grew 50%. Check out the average expansion, 50%. So the question I have is, this was the longest ever, 10 years, but the average expansion is only 5 years. So the question we have, is this the longest expansion ever or the greatest expansion ever? Given we had about average growth and twice as long to get there, we'd say this is the longest expansion ever, not necessarily the greatest expansion ever. And why is that? You could talk to 10 people and get 10 answers. I think a lot of it was the fact that, yes, the Fed kept interest rates very low. The Fed did certain things to get the confidence back and help the stock market. Didn't really help the economy as much. Didn't really use fiscal policy to help the economy. Also, we do have a debt problem. In the United States, we have a lot of debt out there. We had a lot of debt last decade. I think all that debt that we had probably kind of compressed GDP as well. Historically, GDP grows like 5-6% in a good year. The last 10 years during the expansion, we barely printed 3% even in the best years. But look on the right where it says recession, the length of recessions. We're on record again as thinking this could be the fastest recession ever. Previous fastest recession was 6 months in early 1980. And that one, if you think back, if anybody remembers then, Paul Volcker, 6'7", tallest Fed chairperson ever, Paul Volcker, increased interest rates from, I don't know exactly where, very low to about 20%. He and Ronald Reagan wanted to break inflation's back, and they did. It caused a recession. The near-term pain for the long-term gain was worth it, I think, in our opinion. So that was the only other time where the Fed or the government kind of caused the recession, but it was a short recession. And now, right now, clearly the government said stay inside. That caused the recession. So again, there's some similarities there where we think this can be a very short recession in our book. And I'll talk more about what shaped the recession and things like that in a little bit, but just high level, want to set the groundwork that we think this recession is probably over quite soon. Let's go to the next one. So hopefully everybody got to check out The Last Dance. Matt, did you watch The Last Dance with Michael Jordan?
I did. That was a great show. Yeah, I love that series.
Yeah, I mean, we're all stuck at home. So, oops, I'm banging into my speaker here. Or microphone. Yeah, we're all stuck at home. And the thing that got me about The Last Dance, I mean, as a kid of the 90s, loved the Bulls, loved Michael Jordan. Just how many close games they had. You know, like they got the best player in history. And I know that's fighting words, but one of the 2 or 3 best players ever, I think. And then Scottie Pippen, one of the 10 best players of that generation. yet they won so many games right at the end. I mean, how tough is the NBA? Like, you got some really amazing players, but they got the job done. I mean, 6 championships is 6 championships. But still, it's just really unique. But things change. What does Sir John Templeton tell us? The 4 most dangerous words. This time is different. Things do change. So I'm going to take a little weave of where John Templeton sits. Sir John Templeton sits. This is the NBA 20 years ago on the left. Shoot some threes around the basket, baseline, jumpers at the elbow. Check out the game today, 20 years later on the right. You shoot a 3 or you dunk it. That's because guys like Steph Curry, who grew up just right up the road from where I am, shoot 60% from 3 with a guy in their face, or you throw it down low and you dunk it. I mean, the game has changed, right? Things that they've done, the statistics, and they know for a fact, let's just shoot a lot of 3s if we're good at them, because they're worth more points and the percentage of making them is better. So things change. So what in the world does that mean right now? Our opinion is how we communicate is changing things. Here it is. There's my cell phone. Everyone's got one, right? I can order a hot tub, and within 3 days, it'll show up at my house. I mean, it's unbelievable the things that you can do on your cell phone. But the communication thing, I mean, social media has helped make my career. You know, we've got a podcast, LPL Market Signals, all of you are allowed to listen to. I'm on Twitter, do some of that stuff, LinkedIn. I mean, it's helped make my career, being able to leverage social media along with markets and talk. But it's also a negative, right? There's so much information that's out there. I think partially why we had such a big correction is because all that news was out there and it was information overload. Right? We didn't know what to do. All we said was, you know what? Sell first, ask questions later. And that's what the market did. Now, fortunately, we bounced back significantly, but that's almost caught as many people off guard and upset even almost more people that kind of sold in March and April, and then clearly the bounce back. So it's been a really rough environment. But I think what's changed is how we communicate. And too much communication is a real, in my opinion, at least, a negative thing. I mean, you clearly want to follow people you respect and you think are smart, but there can be way too much to look at out there, and it can overwhelm us. And then again, remember what I mentioned? We make bad decisions when we're under stress or when we're overwhelmed, and that's something to be aware of. Let's go to the next chart, please. Yeah, so I love Jack Bogle, founder of Vanguard, true giant in our industry. Here's a great quote. This is the most 2020 quote I can think of. I spend about half my time wondering why I have so much in stocks and about half wondering why I have so little. I mean, back in February, market's making highs. Oh, my goodness, Matt, call up Matt. Matt, why are we in more stocks here? Matt's like, well, maybe we should be a little cautious. And then you get the pullback. And then you're calling up Matt in March saying, Matt, why in the world do I have so much stocks? We should get out of stocks. I mean, that's why it's so tough, okay? And Jack, one of the smartest guys ever to do it, sums it up so well right there. But here's a real key thing, I think, if anything I talk about today that really hammers home, it's this. What we are seeing the last couple months is the hallmark of a new bull market. And I know that sounds crazy when you look at the headlines. I get it. But what we're seeing, we just had the best 50-day rally in history, as you can see on the slide there. Big rallies like this one we've just seen do not happen at the end of bull markets, do not happen during bear markets, don't happen at the end of bear markets. They happen at the start of new bull markets. I know it sounds crazy to hear that, but that's the truth. Look at the numbers on the screen here. 6 months later and a year later, very, very strong returns after the previous best 50-day rallies in market history. 75, late 82, 91, 97, 98, and 2009. You know those dates in your head. Those are some really good times for continued gains, but they took place after bear markets, or at least significant pullbacks in every one of those cases. And that's what we just had. And again, it's the market. The market doesn't care what our opinion is. The market has proven one thing with all the terrible things that are happening. It's cold-blooded, right? It's incredibly cold-blooded. But if you're listening to it and hearing what the market history has told us, what we're seeing right now could potentially resolve much higher 6 months, 12 months from now, again, looking at some of the data there. So that's just something that's really important to be aware of. Let's go to the next one, please. So we'll do a little market history again. So you think about pandemics. In 1918, horrible pandemic took place, which actually took place after World War I. World War I was from 1914 to 1917. 15 million people died. Half of them were civilians. During COVID, I did watch that 1917, one of the, new-ish movie, World War I. Really awesome if you can get a chance to see it. They didn't even start wearing helmets in World War I until like the last year. I mean, that's just, think about that. But after World War I, there was a horrible pandemic that killed 50 million people globally and almost 700,000 in the U.S. Then you had 1919. Which was still a recession, but you also had the Black Sox scandal. As a guy who grew up in Cincinnati, Ohio, The Reds won the World Series in 1919, so we'll take it. It's got an asterisk next to it because you had a team throw the World Series. That didn't help country morale. Oh, then there's a recession of 1920-21. You talk about a bad stretch in American history, that's it. What did that lead to, though? The Roaring 20s. The Roaring 20s saw amazing technological advances, whether it be automobiles, microwaves, washing machines, refrigerators, stock market soared, economy did well. As dark as things looked in 1921 after that horrible stretch, there were some better times ahead. But what did the stock market do during the pandemic of 1918? Dropped about 33%. Fast forward 50 years. Remember what Mark Twain said, history doesn't repeat, but it rhymes. 50 years later, S&P pulls back 36% in the middle of a terrible pandemic. 1 million people died globally, 100,000 approximately in the United States. Fast forward 50 years. Here we are today. We just had a 34% correction. I know those global deaths and U.S. deaths tragically are going to continue to go higher. But every 50 years we have a pandemic. Every 50 years we have about a mid 30% correction. You know, it's kind of one of those things to just be aware of when we're talking about these things. But history doesn't repeat, but it rhymes, and it could be doing it once again. Another angle on this, it's kind of unique. You look at secular bull markets. Those are bull markets that last for decades, potentially. We had a secular bull market from 1950 to 1966, and another one from 1980 to 2000. I know most people say the bull market started in 82. I disagree. The S&P was making new highs in 1980. To me, the bull market started in 1980. So let's take a look at that one from 1950 to 1966. 7 years in, 1957, there was a recession and a 21% correction. Remember I talk about humans and the way the stock market's a human entity almost? There's something called the 7-year itch. It is true. After 7 years, you get kind of tired of things. Well, you've seen that with the stock market. 1980, add 7 years, what do you get? 1987. We all remember that crash. In my opinion, this bull market did not start in March 2009. It started in 2013 when the S&P broke out to new all-time highs after consolidating for 13 years, really going nowhere. You add 7 years to 1913, what do you get? 2020. So every 7 years, there is a big bull market. There's a very scary correction. But what happened those previous two times? Continued stock gains for years in certain cases as the secular bull market just had that 7-year reset. So again, just something to kind of think about big picture as we continue to kind of move forward with our investments. Let's go to the next chart. So we see a recovery coming. This is a picture of GDP. We're seeing some of the worst economic data in our history, the second quarter, but all of a sudden we're starting to see some of the best jumps we've ever seen. We're coming off the mat in so many ways with the recovery here with low economic data. I've seen some data that says the second quarter could be down 50%. We'll see where it lands. Our forecast here is 34%. It's going to be terrible, whatever it is, but the stock market doesn't care. That's backward looking. It's looking forward to better economic data the second half of this year, and we're absolutely starting to see that. Let's go to the next one. So what's the recovery going to look like? This is a cool chart, and I know it's maybe a little heavy, but people say, what's the letter of the recovery? Meaning, is it going to be a V? As quickly as you go down, you come back. Is it going to be a W where the economy kind of bounces around? A U where it takes a lot longer. There's the L-shaped recovery. I even heard there's a K-shaped recovery. I don't even understand what that looks like. But there's all these different shapes of recovery. LPL research is on record. We're actually writing our mid-year outlook as we speak. It should be out. I think it's July 15th. So be on the lookout for our mid-year outlook. We think it's going to be a square root or swoosh shape. It's kind of hard to say. Swoosh-shaped recovery in the upper right-hand corner. So the first part of the recovery, that first part of the V as you come back, it's easy, right? You're soaring. That's where we are now. All right. Things are doing good. It was off the low levels, but it's going to get harder to get that final part of the recovery. And it's like your house, right? If you build a house, sometimes those last things you do, the crown molding and certain things, they just take a while to do. When we moved 4 years ago down here to Charlotte, we've got 4 big boxes in my garage, like up top. I don't even know what's in them. My wife and I, they've literally been there for 4 years. We don't know what's in there. So we haven't had them for 4 years. Clearly, we can live without them. I said, well, I guess when we move again, we'll find out what's in there. It's like the final part of things can take forever to do. And that's kind of what we think this recovery is going to be shaped like. And we wrote that in one of our weekly market commentaries. You can go to lpl.com, our corporate website, and there's our market commentaries there. And you can kind of read those. What we said 2 weeks ago with the shape of the recovery is a swoosh shape. I like to call it a square root. You're thinking about a square root recovery. It's about the same thing. But anyway, that's how LPL sees things. We're in the good part of the recovery, but it's going to get harder the second half of this year. Let's go to the next one, please. So there are some green shoots. What's a green shoot? Well, if you're in a desert, all of a sudden there's some green popping out. That's a green shoot. It's the things that happen before the spring comes. And we're seeing some good things. Look on the upper left-hand corner. That's people using Apple Maps. That's actually, this data was a little old. It's actually more people using Apple Maps when they travel now than they were pre-COVID. Think about that. Okay, restaurant dining, open table, things like that, electricity use, people going through, I mean, nobody was going to the airport middle of April, but people are going through TSA checkpoints. Consumer confidence is high. We are seeing what we call green shoots, which again do suggest we're coming off the mat. Let's go to the next one. And this is kind of a variation of that. On Friday, we had the LEI. It's a leading economic indicators. It's a proprietary indicator by the U.S. government with 10 separate indicators that are, again, forward-looking. Well, you can see there, it had a huge drop, but we just big spike higher as well. So the leading indicators that we follow, again, are suggesting, yes, we had a recession, but we might be out of that recession sooner than most people think over the next couple of months. Let's go to the next one. Let's see what we have. So the Road to Recovery Playbook. Matt, did you guys use this at all, the Road to Recovery Playbook? Or
no, we followed it. Yeah, we saw some check on and check off again.
Good.
It's helpful.
Yeah, I mean, so yes, that's great to hear. So when things were very scary in March, we brought out what we called the Road to Recovery Playbook. And it's, kind of a quantified check mark, if you will, different things we were looking for to show it's kind of safe to put your toe back in the water, so to speak, from an investments point of view. Investments are a little bit different in the economy, although we focus on the economy. At LPL Research, we're on record. The last week of March, we upped our equity allocation. Okay, we were market weight equities. We upped it to overweight the last week of March. We were market weight equities for about a year, from March of 2019 to March of 2020, when we upped our equity exposure. And looking back, that was obviously a good call. I had no idea things would be quite up this much, but these are some of the things that we were looking at that made us feel that way and kind of where they stand now. So let's go to the next chart. I mean, this is all about COVID-19. Okay, we wanted to see the peak number of cases and cases start to roll over. And they did. But what are we seeing now as we start to reopen? That blue line going higher is the 7-day moving average of new cases. It is clearly starting to go higher again. No doubt about it. Now, the number of deaths is the green line going down. Fortunately, that's going down. Now, no question, cases lead new deaths. The reality is there likely will be an uptick in deaths. But you think about COVID-19, just where we stand now versus 3-4 months ago. I mean, just last week, Oxford over in the UK, they said there's a very common steroid that's extremely cheap and all over the place that helped people die at a clip of 35% less if they're on incubators, okay? Every couple of weeks, we find some drug that we already have that is going to help us fight and beat COVID-19. Yes, we think there's going to be a vaccine sometime over the next 6 to 12 months, okay? Various smart doctors are saying the same thing. There are 14 separate vaccines that are in preclinical trials, like human trials, okay, and they're coming fast. And this is one of the, first off, how quickly you can get a vaccine on the market. The fastest any vaccines ever happened from start to finish was 4 years. The average vaccine takes 10 years from the time you start to the time you actually put it in somebody's arm. I mean, that's nothing like we're going to see. The whole globe is working together to beat COVID-19, sharing information, trying to get there. And then you find things like remdesivir, a drug that already is out there that has really good results about fighting COVID-19, and the steroid that I mentioned, some other drugs. So there are some good things. There's also 140 separate vaccines in preclinical trials. Okay, so we've got the clinical trials right now, about 14 of them. Then the other side of things with aren't in humans yet, but are getting there, 140. What did Wayne Gretzky tell us? He said, you miss the shots you don't take. Guys, we have a lot of, no pun intended, a lot of shots with the vaccine. We have a lot of shots as it pertains to vaccines. I mean, Dr. Fauci is on record saying we might have 2 or 3 of them by the end of the year, right? Some might do this, some might do that. They all help fight it. So there are really, and that's what the stock market's looking at. That is why the stock market is up so much, in our opinion, why the NASDAQ's making all-time highs as I speak, or as we speak. It's looking forward to beating this. But the positive news, if there's any positive news, and there's not a lot, I get it, is deaths continue to trend lower. People on incubators trend lower. Number of people in hospitals are starting to curl a little bit higher. But again, there are more and more cases, more and more testing. Younger people are going out. They're the ones that are getting it. They clearly don't have the same impact as people 55 or older. So there's no easy answer here. But again, we are so much better armed to fight this than we were just 3-4 months ago. And 3 or 4 months from now, we're going to have more and more drugs, hopefully, that help us, and maybe even a vaccine. So let's go to the next one. I better start moving a little bit here. The U.S. economy in recession. One of the things we wanted to see was the economy in a recession. I know that sounds a little weird, but in March, what I'm showing there, 7 million. There were 7 million people filed for initial jobless claims the third week of March. All-time record, just shattering any record. The S&P went up 6% that day. I can't tell you how many people from the media, how many family and friends said, how could 7 million people file for initial jobless claims, yet the stock market goes up 6%? I'll tell you how. It was priced in. The stock market hates uncertainty. That was the certainty of, oh my, we're in a recession. It's a bad one. We wanted to know that. And again, from our playbook checklist, that we're in a recession, because that means there could be stimulus coming, right? And markets tend to do bad before the recession. They sniff it out. Once the recession's happening and about over, that's when things start to bottom. So that was one thing we wanted to see. Let's go to the next one. What is that? Okay, so the stocks are down 34%. That's a pretty good size correction. Even in a recession, that's a good size correction. Stocks were really cheap. What we show here is just stocks got cheap on a PE, price to earnings multiple. Again, just a check mark to potentially future positive returns. Let's show the next signal that we were looking at, signal number 4. Be greedy when others are fearful. Famous quote, Warren Buffett. This is the Fear and Greed Index by CNN Money. We hit one out of 100. I mean, there's about as much fear as you're ever going to see what we had the third week of March. And it's very easy to say, buy when there's blood in the streets. And when it's your portfolio, it's so hard. I'm fully aware. But that's why having a plan and work with Matt and the team, it just makes sense to continually have a plan before you get there. It's the Wayne Gretzky quote. I guess I'm quoting Wayne Gretzky a lot today. Skate to where the puck is going to be, not to where the puck is. You have to see these things are going to come and use them as opportunities. Stock market's the only place where things go on sale and we run out of the store screaming. I mean, that's another one, but that's the truth, right? Things go on sale. Usually you're excited. Stock market, that's not the way it works. People get panicked. Yet history tells us every 20 years, the S&P is higher on a total return basis. And again, you buy in 1929, you buy in 1987, you buy in 2000, you buy in 2007. Well, those are some pretty terrible times to buy, and it took a long time to get back. But if you're willing to buy when things are 25, 30, 40% off, if we ever get there, or we will someday again, 40% off the highs, the historical returns 1, 3, 5, 10 years later are really, really good. Let's go to the final thing we're looking for. We wanted to see bold policy response. That's the Fed, that's the government. When I do these presentations, I always get the question about the Fed and the government. Fed's printing money, government's, they're doing their thing, not trying to help everybody or trying to help select people. We think what the Fed and the government did, it had to be done. Okay, and this is a percent of GDP. That's the orange, the fiscal policy and the monetary policy versus the blue. That's how much policy there was during the financial crisis 10 years ago. We've had so much more stimulus, again, because we shut the economy down, so we kind of had to. But we're the camp that the Fed and the government did a lot of things. None of it's perfect, by no means, but they had to do it. And I get it with the Fed. The problems with the Fed. Why can they just print money out of the blue? Why is the Fed not audited? Why does the president get to pick who's in charge of the Fed? Why can't we, the people, vote on it? Why is the Fed book so closed? Why can't it be opened up? I get all those concerns. We do. But again, the Fed literally, as we speak, is buying junk bond ETFs. I never thought I'd say that. This is not your father's Fed. They are doing everything they can for two things: confidence and liquidity, trying to bring those two things back. And on March 23rd, they said they're going to start buying investment grade bonds, individual corporate bonds. March 23rd is also when the market bottoms. So there's the old saying, don't fight the Fed. What the Fed is doing is very out there. They're being very clear about it. They're trying to bring back confidence and liquidity. And think about this. Jerome Powell, he's the guy in charge of the Fed, has been on 60 Minutes 3 times the past year. No Fed chairperson's ever done that. The Fed is really being out there with what they're trying to do. So again, it's not perfect, but they're doing it. And I love this quote by Lou Holtz. As a Ohio boy, I'm an Ohio State fan, so I don't like Lou Holtz. I like Notre Dame, but that's all right. But I love this quote. 10% of life is what happens to you. The other 90% is how you respond to it. So, okay, you're in a terrible pandemic and recession. That's 10% of it. How do you respond to it? Whether you work with Matt and the team on your portfolio and not panicking in the midst of a terrible, terrible situation, or what the Fed and the government have done, the things that they've done, the unique things they've done to try to create a bridge to the people that have been so impacted by this, to when we get to that other side and start to open up, like we're starting to slowly here. That's kind of what we're impressed by. Let's go to the next slide. I'm going to try and wrap it up here fairly soon. What do you see? So this is, again, I guess, Matt, do you guys have KFC out west? I mean,
Oh, yeah.
Okay. All right, good. Okay. So I see KFC and I think, fried chicken. I get a little hungry seeing that one. I showed this to my son. You know what my son said? Why is his body so small? Now you will never see a picture of the Colonel and think, why is his body so small? But we all see different things. We all have certain perceptions on life and how we're molded and our experiences that make us think the way we think. Let's go to the next slide. What do we see right now? What matters? Earnings drive long-term stock gains. This is S&P 500 forward earnings. They collapsed in April. Not a shock. We're in a recession. Earnings collapsed. 190 companies didn't even give forward guidance. Okay, China, who every year gives a GDP forecast, which you might be shocked to hear. They actually nail every single year, whether you believe it or not. China's not even giving forward GDP guidance. Okay, but what we just saw is unbelievable because the stock market bottomed on March 23rd. 52 days later, earnings bottomed and started to go up. Take a wild guess. The March 9th lows in 2009. How many days later earnings bottomed and went up? Yep. 52 days later. And in that part of 2009, as earnings started to go higher, people doubted. I remember going on Fox Business, literally getting laughed at for being bullish the second half of 2010. You couldn't be bullish. People don't remember this. I think it's been this easy 10-year bull market, or it was. It wasn't anything like that. If you were bullish in 2010, 11, 12, you were laughed at in some cases on TV. and it is what it is. But we're seeing some similar signs that we saw coming off that major low in 2009 where earnings bottom started to go higher 52 days later. Show the next chart, which is actually the U.S., EFA, which is Europe and Far East, and then emerging markets. The blue is the U.S., S&P 500. This is, again, earnings estimates out 12 months. Check it out. U.S. is starting to bottom and go up a little bit more than the others. So U.S. is starting to recover here a little bit more than the rest of the world. How we're looking at our models and the money we run, we like the U.S. still. We still like growth a little bit here, overvalued by just a little bit. We don't like developed international. We still have issues with Europe. We think Japan could be an upside surprise, though, the second half of this year in developed markets. And then also emerging markets. We see some opportunity there. A lot of bad things have happened, yet the data in China and some of the other places in the Far East really have started to improve. So we like the U.S. We like emerging markets. Not quite as warm and fuzzy on developed international. Let's go to the next chart. How are we doing time-wise? I'll try to get this wrapped up soon. Okay. Earnings have dropped significantly. Okay, not shocking. These are all the recessions back to World War II. Earnings just dropped about 24%. The average earnings drop during a recession is 25%. I mean, we had earnings drop 90% during the financial crisis, as you can see. But we had a major hit to earnings. And again, remember, earnings have started at the bottom. They started to go higher. A lot of the economic data is starting to improve much faster than we thought. So earnings very likely could improve as well. Small businesses, which drive the economy. I mean, in the private sector, small businesses make up more than half of all the jobs in the private sector. A lot of small business confidence numbers we're seeing optimistic about 6 to 12 months from now. So if small businesses are sniffing out that recovery, earnings are going to come back as well. So earnings likely just bottomed at about 25%, which is right about average. Here's a little funny joke about average. There's a statistician. He put his head in the oven and his feet in a bucket of ice. And I say, hey, how you feel? He goes, well, on average, I feel pretty good. There's really no such thing truly as average, but nonetheless, this is right about in that range where things tend to bottom. So let's go to the next chart. So the calendar is a worry. Again, I talked about the bottom in March, the rally into June, and the sideways consolidation in 2003 and 2009. But also the calendar is not doing anyone any favors. For whatever reason, May to Halloween, as you can see on your chart there, is historically the worst time of the year for stocks. And you think the last couple of years, we've had some summertime corrections. You look at election years, you have some summertime corrections. After a 45% rally, I've laid out, we think stocks will be potentially a lot higher this time 12 months from now. But we're not naive. After a huge rally like this, and some of our more tactical models or models that are a little bit more aggressive in terms of how we trade them, we've taken off a little bit of risk, anticipating, as much as a 12% correction. You look at market history. After major market lows, you get a big bounce. We just had a 45% bounce, by the way. About a 12% correction is the average correction. So we think, some consolidation and a little bit more of a pullback. It'll be scary when it happens, but in a calendar is not doing anyone any favors. The next slide, show them that next slide. It's another concern about stocks are expensive. This is PE multiples. We've got the highest PE multiples on the S&P in 20 years. So stocks are, quote unquote, the most expensive they've been in 20 years. It's not quite that simple. We've got low inflation, low interest rates. So you tend to have higher multiples under that scenario, but still stocks are expensive. Now think about the P part of price to earnings. That's the price. That's the S&P 500. We know what that is. That E part, oh my goodness, it is so tough to come up with that because as our mid-year outlook, we're working on it. So much depends on what? On COVID-19. If we get a vaccine the next month or two, earnings are going straight up. Get a major outbreak with the second wave, which we're not in that camp. I mean, we don't think there'll be a major second wave, but there's potential it could happen, and that could really hurt the earnings part to the downside. So there's a lot of uncertainty there. But again, just a near-term concern of LPL Research is stocks are not cheap anymore. They were cheap, but they are getting a little pricier here. Let's see what the next slide is. So there's a picture of a duck. Show the next slide. Well, look at this. It's a rabbit. I told you it's a duck. It was a rabbit. Very rarely does anyone say, I saw a rabbit the whole time. Our brains hear what you hear, and you can see it. Show the next slide, though. Check this out. Stock market's going up. You've heard about the day traders that are out there, betting on, airlines and cruise ships, and retail is beaten up. So, people are happy. Market's going up, right? But show the next slide. This is the economy. In 22 years doing this, I've never seen the economy and the stock market this disconnected. They usually kind of jive a little bit. They're not. I mean, they're not. There's no doubt about it. But wouldn't it be something right now if the economic data is getting really strong and now the stock market takes a little break when it was rallying, when the economic data was terrible? I mean, that would be very 2020, I think. So this is unbelievable. I love this picture. I don't love it. Actually, I hate the picture. But it's a really good way of summarizing kind of what we're seeing where stock market's going up. But the average person has really, really felt so much pain. My father-in-law owns a restaurant in Cincinnati. This restaurant's like shut down. They have 200 people a night coming back in February. And they're dealing with, they're opening up now, but it's not the same. My brother has he sells toys for a living. He owns more G.I. Joes than anybody goes to big toy shows, sets up at the Holiday Inn. His business has been shut down. He's doing online, but I get it. I mean, fortunately for me, I've been okay with my job with what's going on, but so many people have been impacted by this, and we're not blind to that. So we say, the stock market's up. People don't care. I mean, if you lost your job, that matters so much more. And this is such a different situation than any time we've seen in history where the stock market and the economy are not jiving at all. But let's go to the next slide, which shows what we usually see. And there's anything I say that you remember, it might be Colonel Sanders is a small body, but this is the other one. Stocks lead the economy. And what I'm showing you here, we found in market history, stocks bottomed 5 months before the economy. What I mean by that is 5 months before the recession's over, stocks have bottomed and start going up. Look at 2009, March 2009, major market low. We were in a recession until July, okay? 5 months on average is when it happens. We just had a major market low in March. Add 5 months, if my math is right, that's April. We might be out of this recession by April. Our base case, honestly, is we're probably out of this recession in June or July. But August would be 5 months, and that would be perfectly normal. From the March lows, add 5 months. So just be aware that the stock market leads the economy, and we think it's doing it once again. Let's show the next slide. So people say all the time, what's your favorite chart? It's kind of like picking a favorite kid. Go ahead and show them my favorite chart. Next slide is pie I've eaten, pie I've not eaten. There's a lot of pie to eat. I love that. Love that pie chart. Let's go to the next slide. Almost done, guys. I've got a couple more, then we'll do the question. Yep. Okay. Yeah, definitely. We're at the end here. So here's some big picture stuff for you guys to remember. Big annual declines are rare. As you can see on the screen here, to the left is when stocks are down 15% or more. To the right is when they're up 15% or more. It is so much more likely to have a big up year than down year. Now, big down years happen. 2008, 2002, 73, 74. Earlier this year when stocks were down 30% for the year. I mean, that was pretty devastating. So I don't want to minimize it. But it's so important to do a big picture look to know that stocks are going to be up a lot more than they're going to be down if you look at historically. And the other thing to take away here, S&P's maybe flat for the year almost. If you can sit on a total return basis as we speak right now, maybe down a little bit. I mean, like I said, NASDAQ, up like 12% for the year. But what we tend to see if stocks are down, if you don't have a recession in next year, which we don't think so. Earnings are supposed to be down 25% this year. It's supposed to be up like 30% next year. And we think it maybe could be a little bit better than that. So if you don't have a recession in next year when stocks are down, you can have massive gains. Yes, 73, 74 stocks are down. Yes, 2000, 2001, 2002 stocks were down. That was a major bubble, extremely expensive stocks then. 73, 74, one of the worst recessions we've ever seen. So if stocks are down this year, which could happen, that next year into 2021 could be a really big opportunity for potentially significantly higher prices. So just think about that. Now let's talk about the president. I always do this at the end, and I like to leave. Let's go to the next slide. People like to talk about, how can you who could win the election? Can the economy predict the election? Maybe. If you have a recession 2 years before the election, the incumbent president loses. If you don't have a recession 2 years before the election, the incumbent president wins. It's kind of that simple. It's worked every single time since Calvin Coolidge. You can see here, George H.W. Bush had a recession, Carter had a recession, Ford had a recession, and Hoover had a recession. All of them lost. So that's kind of fascinating. So what's it mean for President Trump? Does it mean just blindly he has to lose because we had a recession? Well, what did Lee Corso say? Not so fast. Let's say we get a major drug breakthrough or major vaccine breakthrough by August or September. With all the record stimulus I was just talking about, the economy could really be humming by the time we go to vote in November. The stock market could really be humming by the time we vote in November. And history would tell us how the economy is doing. You tend to vote with your pocketbooks a lot of times. So just kind of be aware of that. And we're going to talk a lot more about this stuff in our mid-year outlook, which we're releasing in a few weeks, and a lot more on lplresearch.com and different places about the election. But that's just something unique. And the last chart's the next one here. Can stocks predict anything? Well, maybe. If you go back in market history, how the stock market by the S&P 500 has done 3 months before an election is usually right. Here's what I mean. If the stock market's up, the incumbent party wins. If stocks are down 3 months before, the incumbent party loses. It's been right every single year since 1984. It's been right 20 out of 23 times going back to 1928. Think back to 2016, for example. Everyone, including LPL Research, thought Hillary Clinton was going to win. Not the stock market. The Dow had a record 9-day losing streak directly ahead of the election in November 2016. Copper, the pro-President Trump potential industrial metal type of play, copper had a all-time record 14-day win streak directly ahead of the election in November of 2016. So as we get closer to this election, kind of how stocks are doing, how copper is doing, some of these other things, we're going to be looking into this. And that, again, could give a little bit of a clue who will win the election in November and likely be in the White House in January. And just last thing I'll say, because it always comes up, what's it mean if, the Republicans win or Democrats win? Here's the truth. There have been bull markets under Republicans. There have been bear markets under Republicans, vice versa with Democrats, bull markets, bear markets. How the economy is doing matters so much more. It's so important to separate our political views with our investments. I know that's hard to do. A lot of people didn't like Obama. Stock market did great. A lot of people don't like Trump. Stock market's had a pretty good run. I know the big pullback, but now we've bounced back. So it's important to separate that. It's hard, but it's important to do that. And one of the best scenarios is having a split Congress, right? The best Washington is actually one that can't get anything done. If you get one party with too much power, that's kind of where you shift a little bit too much. The stock market doesn't always like that, right? Stock market likes checks and balances, like our four founders wanted it. And we'll see how Congress breaks out. But if that stays split, that could probably be more of a tailwind for the economy and for stocks going out the next couple of years. And last thing. So after President Trump won, everyone said steel and coal would do great. And also they said technology would be weak because he's going to go after technology companies. Technology is about the only group after the first week after President Trump won, when stocks went up a lot, technology didn't, okay? Because he was supposed to be anti-technology. You look past 4 years later, where we've been, technology literally is making all-time highs as we speak. It's by far the strongest group out there. Steel and coal have really, really struggled. So just because it's totally obvious to everyone, it's also obvious to the stock market. It's also priced in. So you're going to hear about, Biden wins, it helps this group. If Trump wins, it helps this group. I'm not saying ignore it, but I am saying if everyone's talking about it, it might not work out as easily or as obviously as you expect. So with that, I am done. We can do some Q&A, Matt.
Awesome. So we got a couple questions for you, Ryan. First one is, what's your take on so much money sitting in money markets right now? It seems like everyone's pretty defensive, even after this big rally.
Yeah, that's the truth. And we wrote about this on our blog last week. There's approximately 4.8 trillion with a T money in money markets right now. That is double how much money was in money markets about 5 years ago. And we just had one of the largest 3-month spikes ever. And it's the truth. Like people are getting more money, right? The government's literally sending people money. So maybe some of that money is working its way to money markets. But also we think, a lot of people sold and they still went to cash. A lot of people have missed this rally. And that's the sad truth. Also, if you look at cash in bank accounts, which is different, there's almost 15 trillion, all-time record, 15 trillion in cash in bank accounts. You add those two numbers up, that's $20 trillion. It's cliche to say, oh, there's cash on the sidelines. But there really is a lot of cash on the sidelines. And I laid out our view, right? We think the stock market could have a well-deserved break here, but we would be buyers. In the money that we run, $30-some billion for our advisors, for your clients, we are absolutely looking at adding to equity risk on any types of pullbacks, again, going forward, because you see things like a lot of cash on the sidelines. There's a lot of, hey, the truth of the matter is also, no one's an expert. I mean, there are some smart guys. Warren Buffett, right here, David Tepper, the guy that owns the Panthers, Druckenmiller, guys who've forgotten more about the stock market than I'll ever know, have been very vocal, not believing this rally months ago, and this market keeps going up. So this market's made fools of a lot of investment professionals. So if you think you're confused and you think you've missed some things, don't feel bad, guys, because a lot of smart people have missed it also. But there's a lot of money that can chase this thing also. So any pullbacks, in our view, will be continued to be bought as long as the economy keeps kind of turning and churning forward, which we think it will.
Perfect. Got a couple more about money printing and all the debt that we've taken on and what sort of long-term issues that could have.
I hinted at some of that. I mean, the more debt we have, it will hinder growth. I mean, we saw that last decade, right? I mean, it is what it is. We kind of had to do it. And here's my little I'll try and do a 2-minute spiel on debt. We've had debt in this country for as long as any of us have been around, right? After the Civil War, there were concerns about the debt that's out there. In 1971, the United States had the dollar pegged to gold. John Connally was the Treasury Secretary for Richard Nixon in 1971. They severed that. That upset a lot of bankers around the globe. This is folklore at this point now, but John Connally looked these bankers in the eye and said, hey, it's our currency, but it's your problem. Guys, for 50 years now, that has been the United States attitude. Remember when I said stocks were down, bonds were down, gold was down into the March 23rd lows? You know what wasn't down? The U.S. dollar. When the you-know-what hit the fan, people flocked to the safety of the U.S. dollar. We call the U.S. dollar the cleanest shirt in the dirty laundry. It's not like it's that great, but it's still the currency you go to. As long as we, the United States, have the world's reserve currency, whether you agree with it or not, and honestly, I don't think you should have too much debt, we're going to continue to use debt to our advantage, and the world's reserve currency tells us that. So it's a tricky situation. I don't think debt's going anywhere, but let's be honest, with rates this low, with inflation this low, if you're going to roll out a $1 trillion stimulus package with infrastructure, you might as well do it now with rates so low and interest rates so low. So there's a lot of debt out there, but the amount we have to pay on the debt actually is not as much as you might think when you factor in the fact that 10-year yield's less than 1%. So I'm not saying we don't have a lot of debt out there. We do, but there are some different ways to look at it. And the last thing on this little spiel, this is one of the few places the left and the right agree. The left and the right agree China is going to have to pay for what they've done. I mean, the left and the right agree on that one, but also they agree about the idea that more debt is probably how we're going to continue to support ourselves to get out of this. And those are one of the few places that the Washington tends to agree.
Perfect. And then going along with that question, is inflation the real risk going forward? Is deflation potentially the problem?
Yeah, I mean, you look about the Great Depression, deflation is what took place. But after the Great Depression, there are some different things that took place. The government increased taxes. After the crash of 29, I should say. Government increased taxes. The Fed tightened monetary policy. There's a global trade war. And there's one more thing, regulation. There was massive regulation. You look at what's going on now, we're not seeing those things, right? The Fed is loosening. The government's sending people money. There's no global trade war. I know U.S. and China going back and forth a little bit. It's nothing like the 30s. We see some major differences. So we think inflation could be the worry. Now, I'm aware. You look at CPI down 3 months in a row for the first time. That's core CPI down 3 months in a row. We've never seen that. We've also have a 100-year pandemic hitting us. But we do think that. Now, here's a big picture thing. Look at what caused, again, I held my phone up earlier. I joked about a hot tub. Within 5 minutes, we can find the cheapest anything you want on your phone. Globalization has caused, we think, a lot of the disinflation that we've seen, right? Globalization. What's going on in the world right now? It's it's kind of nationalization, right? It's okay, let's bring our supply chain back from China. A lot of places doing that. If you think one of the reasons we've had lack of inflation is because of globalization, as we move away from that over the coming years and decades, like we think could be the case here with COVID-19, everything has just happened, maybe that can kind of spark some inflation. And believe me, I get it. All the money printing, we were told last decade, all the money printing was going to cause Zimbabwe-like inflation. Well, it didn't happen. Okay, I mean, it just bottom line is it didn't happen. But we do think a little bit of inflation could be the next thing we should worry about. Let's say 5 years from now. And what are we doing about it? Well, we still think stocks can go up, but we've upped our allocation to gold. Do you guys have an opinion on gold, or what do you think of it?
No, we're in the same boat. Yeah, we've added an allocation to gold.
Well, there you go. Yeah, so if you think inflation is going to start rearing its ugly head, as we say, gold could be a potential nice way. And again, I mentioned that we took some risk off in some of our more tactical models. You know what we did? We added some gold because, again, we think gold literally today made its highest levels since 2012. I mean, yeah, the Nasdaq's all-time high, but gold's going up. Keep it real simple. It's going up. And with inflation and all the issues that are out there, that's one little pocket that I think you guys, before you make a decision, talk to Matt and people on the team. But that could be a place that you could benefit potentially from more inflation, and that's what we see the next 5 years over deflation.
Perfect. And then we'll do one last one. So in this current market, obviously you guys are in the more optimistic camp, especially over the next 12 plus months, like us.
Yeah.
What is something that does keep you up at night with the economy or what's going on in the world right now?
Yeah, I mean, it's almost the same as everybody else. I mean, a major phase two. I mean, another a second phase breakout. I mean, these numbers that we're seeing, it's amazing the way the economy continues to shake it off. I mean, the stock market continues to shake it off. I mean, we're not too far away from new all-time highs on 7-day average cases here. I mean, that is one thing that really gets us. And also the U.S. dollar. Okay, the U.S. dollar. I didn't talk too much about that. The U.S. dollar, when the U.S. dollar is strong, if you look back in history. I did talk about the U.S. dollar. I'm sorry. I talked about it, but it started to go down after the recent scare sell-off. If the U.S. dollar strengthens, that's usually a time you got to look around and be worried about things. So if the U.S. dollar strengthens too much, and that could be the case, that could be time that the economy pulls back a little bit, stock market pulls back a little bit, and potentially a higher dollar could impact gold and push that a little bit lower. So what happens in the currency markets get us as well. But overall, and the overvaluation. I mean, stocks are expensive, right? Now, yes, inflation is low, interest rates are low, but stocks aren't cheap here. They were cheap back in March. That was 45% ago. Okay, I mean, think about this. We've never had a year in market history that was down 30% for the year, like we were on March 23rd, finish higher. Very well could happen this year. 2020 is just a crazy year, breaking every record. But this is an historically stretched rubber band. And I laid out why the big surge originally off of lows tends to lead to higher prices, 6 to 12 months from now. But in the near term, we have had a heck of a rally, obviously. And those are some of the things that kind of get us. But overall, we're not staying up at night super. Well, I mean, we get paid to worry, so I don't mean to put it like that. But it's just still, there's so many more reasons to be optimistic here. We like to use, my podcast is called LPL Market Signals, okay? We use market signals to try to take away the emotion, to use quantified data to show fundamentals, market technicals, valuations. Those are things we focus on our 30-person research team every single day with the money that we run and the collateral that we create for our advisors and their clients. And we're not just blind bulls here. Like I said, we took some risk off. I mean, we're looking for a pullback, but we really do think, there's still the upward trend is the way to go. And who's to say, maybe where we could be wrong and what worries me the most is all this stuff keeps working. We get a vaccine, all this stimulus here. Who's to say the stock market doesn't go up a lot more? The average stock, Matt, the last 2.5 years, you know what it's done? Gone nowhere. The small caps have made a new high for 2.5 years. I mean, what if all this stuff actually works? And no one believes it because everybody's so worried about everything. Rightfully so. It's devastating what's happening. But if the good news takes over, where we could be wrong is we're not nearly bullish enough. And that's kind of one thing that I do kind of worry about on that side also, which I know is a lot different. You hear, what are you worried about? You always think the end of the world. Maybe the world's not going to end and good times are coming. And we're not positioned enough to get enough upside to that. That's kind of one thing that has me there.
Perfect. Okay. Well, thank you so much, Ryan. This was great. Definitely plug your podcast. I think it's weekly, or is it bi-weekly?
Yeah, it's weekly. Let's see, iTunes, Google Play, or Spotify. LPL Market Signals. We do it every Monday. It's released Monday around the close.
Yep. So highly recommend that. My wife and I usually listen to it every Monday night when we're walking our dog. So
oh my goodness,
that's a good one.
Well, thank you for that. That sounds almost kind of boring, but thank you. We try to have fun. The podcast is fun. I try to keep it lively. The podcast, you don't want to be too geeky, so we have fun with it. But thank you for doing that, man. I appreciate that.
Well, thank you so much, and thank everybody for tuning in. Hopefully you guys enjoyed it. If you have any extra questions, feel free to email me personally, and hopefully I can answer. And if I can't, I'll bug Ryan a little bit more. But
Absolutely. Yep.
thank you again.
Okay. Take care, everybody. Bye-bye. Thanks, Matt. See you guys.
Bye.